Hello, Amelie.
Good evening, ma. Hello, good evening, ma. Can you hear me?
I can hear you.
How was your day?
I'm just coming from a party. Now I was trying to connect on my phone.
Hold on, ma.
And the visibility, the road was so foggy, we couldn't even speed. We were trying to do 100, 110 to get home on time.
One time.
Hmm.
Hold on, ma.
Oh my God, this this so well. Hey God, how was Sunday today?
Very well. We thank God. Beautiful.
Awesome.
Yeah.
Ah, I need strength. I pray that God strengthen me tonight because after eating all the party food, I don't know. I'll take run tonight's class, but we will do it by the grace of God.
Yes, ma.
So we do impact of debt on a business. So, 10.
From the window.
Hi, Bola, how are you?
I'm good. Good evening.
Evening, my dear. How was
I
your
see we
day?
were up and about today.
Oh my God. Yes, sir. Yes,
I can
sir.
imagine. Thank you for making time out.
You're welcome. You're welcome. Okay,
I
for
appreciate you. Oh,
yeah.
Hi, teacher. I need a hat. Okay, fly, like butterfly.
And so we're going to start now. And
Okay.
this morning class was really deep. How many of us have been able to catch up?
I've seen a
Not
bit
yet,
of
right?
it. I saw that you
Anyways, you
were
guys are
firing
going
down.
to be having a whole week to bring yourself up to speed, right?
Amen.
Yeah, so I'll recommend that you guys do that. I took my time to explain some key principles this morning. I didn't rush it. And if you guys get those principles, everything will fall in place. Okay. All right. So tonight, without much further ado, the time is fast spent, and it's a Sunday night, and Monday morning is knocking at the door. And so how do you guys want us to do it? I'm looking for us to do chapter 8 and chapter 9 tonight. Can we commit to that? Okay. And because it's a Sunday night, don't worry. Maybe we'll do chapter 8, and then I'll make out time sometime tomorrow to take chapter 9 and upload it and then share the link, what is it called? The
The
link for you guys
explanation, the
to,
video.
yeah, to the
Okay.
video. Okay. Because I just want to make sure that we are up to date with everything we have mapped out for this weekend. Okay. At the same time, I
Okay.
don't want to over push you guys beyond. Okay, so who else is not in class now? Okay, Chamaka is on her way. She's going to join us momentarily. Hey, huge welcome to Mr. Adonke. You're welcome, sir. So good to have you.
Thank you.
Welcome.
Thank you. Thank you.
Awesome. Okay. So, and have I been recording the whole time? Oh, let me see. Oh, been recording the whole time. Anyways, so yes, as usual, we typically record the class and then we have opportunity to get back to it at a later date to play catch-up review and all that. And right now we are continuing our life insurance module class in chapter 8, which has to do with business insurance. Okay. You see the trajectory that this course is taking us, right? When you follow it, it's like precept upon precept. We started with individual life, then we look at term insurance, we look at permanent insurance, and then we see how the permanent insurance, we have 3 permanent insurance. We have the whole life, the term to 100, and then the universal life. And then we moved on to group life insurance, right? And then we now move on to impact of taxes on all these insurance products. And that was what we dealt with this morning. And now we are looking into business life insurance. All the business owners in the house, you see, when you get this one, you'll be able to come up with a value proposition for business owners, for entrepreneurs. Okay, so there's a tons of knowledge here for us to learn from for our own personal business purposes, because almost everybody on this call right now are business owners. So without further ado, let's dive into this. Okay, now potential impact of debt on business. Can you even think of what that could be like? Right? While death is often thought of as a purely personal event, unexpected or premature death can also have a devastating impact on some businesses, especially small and startup businesses that are dependent on their employees for their continued success. Okay, the death of a business owner or employee who is key to a business can have a significant negative effect on the overall success of the business. These effects may include the following: loss of skills, creditors' demand, family interference, equality for family members, and capital gain taxes. All right? There are so many businesses that were not able to see the light of day after the demise of the owner of that business, right? So we're going to be looking at these 5 effects one by one. The first one is loss of skills. You see, many businesses have an employee or a combination of employees whose skills are vital to the business. The employees may have a long-term knowledge of the business. Okay, so again, once I move like this, then I don't see. Okay, let me move my distance. Okay, 210. Okay, so lots of skills, all right. Okay, a lot of expertise or ideas that others do not have. Sorry, I'm having to baba because when I scroll my screen down, because of the way the text is, when I scroll to the next page, sometimes I lost track of where my eye was. Sorry about that, guys. Right? So, and this knowledge and experience, lots of skill, okay, may also be difficult to replace. So now, like lots of skills, like in some businesses, right? The key person, the key employees, is so valuable to the organization, such that if anything happens to that key employee, right, to replace that employee's key skills might be very, very difficult. And that will lead to that business suffering some setbacks. Okay, such an individual, such a person is instrumental to the business success. And this is the person who is called a key person. A key person employee, for example, is that individual whose skill is highly valuable to the business. Okay? An example of such individual could be a craftspeople, a charismatic individual, a salesperson, or an influential vice president, someone that influences for the business. Okay, and the skill of this individual is not limited to all these skills that we have just mentioned, but just mentioned but a few, right? Therefore, the death of a key employee can bring about the collapse of the business. So if revenue decline as a result of the death of the key person, so you can imagine what will be the fate of the business. So how will this business that relies heavily on this key individual protect themselves such that if anything were to happen to this key individual, that their business will not suffer significant blow, right? So again, when we are talking about key individual, it doesn't necessarily have to be the employee. It could be the business owners himself, the business owners herself, all right? This is a typical example. Monica is a talented architect who works for a company specializing in the design of professional offices for lawyers and surgical specialists. The owner of the firm believes that about 30% of their business is due to the clients who specifically seek out Monica's talent. Monica's death will have a significant impact on the company's revenue. So in this case, now Monica is a key vital individual in this organization. However, this individual, this key person could also be the owner of the business. Okay? So that is when we are talking about skills. How about creditors' demands? Okay? So businesses may take a loan in the form of business may take on loans in the form of demand loans, which have no fixed term or set duration. Instead, a demand loan must be repaid to the lender on its request, as long as any required notice is provided. As long as any required notice is provided. So the death of a key employee can make the lenders to become nervous and say, you know what, see, this is the person holding this business. And therefore, if this person is no more, what is going to be the fate of this business? Therefore, they can come after, like, we need our money ASAP. You understand? It's the race to the finish line before anything will happen and they'll go and file bankruptcy. Everybody is racing to get what belongs to them. So that's what a death of an employee or or a creditor's demand could lead to, okay, if anything were to happen to a key person. Then the next one is death of a key employee can make lenders very nervous. Okay, so we've talked about this one, right? Now the next one is family members interference. You see, businesses created as partnerships or private corporations may have more than one owner. For example, Abid and his brother Amir, Farik and Dinesh own a company that imports patients' rugs. They each own a 25% share in the business. Problems may arise if one owner dies and their family members or members inherited the deceased owner's shares of the business. So to continue the example above, if Farid dies, especially his wife Goha will inherit his shares. and those inheritors may not be familiar with the business and may have unrealistic expectations for profitability and distribution of revenue. So to continue the example, Farid never revealed any details about the business to Goha, who is his wife, who expects dividend to be paid quarterly. However, if dividends are paid quarterly, money would not be available in the business to buy more inventory. So without inventory, the business will be what? Without inventory, the business will suffer, right? So without inventory, so now I'm now looking for where I stopped. Um, okay, let me go back. Um, okay, so without inventory, the business will be ruined. Okay, I get that. Okay, so an inheritor may be willing to sell their newly acquired shares of the business, but at a selling price that is unreasonable, unrealistic for other owners to pay. So to continue the example, Goha may be willing to sell the shares of the business she inherited from Farid. However, with no knowledge of the business, she sets a price that is too high, and the remaining shareholders refuse to meet her price. Family hostility ensued. And a typical example of this is Jason, Ivan, and Connor were the joint owner of Restful Solutions, a funeral home that caters to the upper class of the society. Jason died without a will, and he was with survived only by Mason, his 24-year-old son. Mason is a troubled young adult with a history of petty theft and drug use. Mason inherited Jason's ownership interest in Restful Solutions. He showed up drunk at the funeral home shortly after his father's death and loudly announced his intention to take over his father's role in the business. When Ivan and Connor tried to tell him that it was not a suitable role for him, he demanded a $1.2 million for his shares in the business. Okay, so now this is a very straightforward example. And this happens a lot and almost all the time, right? When the key individual, be owner of the business or employee of the business, died or is disabled or something tragically happens to them, then the business starts suffer diverse fates, okay, that they may not even have anticipated. All right. Now, the next one is equality for family members. Okay. So, how would family members be fairly treated in this case where, where this is a family business? How would they be fairly treated? Well, equality for family members, as a parent who is a business owner who mostly or probably want to treat all his children fairly when it comes to distribution of his estate. It is important to note that treating children fairly does not mean treating them exactly the same or identical. Creating a fair distribution can be challenging, or can be a challenge when children have different expectations or differing expectations. But it's especially important when planning business succession. Parents may need to be creative in order to put plans in place that treat all children fairly. A typical example of this is Christiana is a sole owner of a very successful garden center. Hibiscus, which is an incorporated company with about $1.5 million, right? Christiana has 2 children who are in their 20s. Harry shares his mother's passion for gardening and has worked at the gardening center since age 10. Nancy is a doctor and has never had any interest in the business. Christiana would love for Harry to carry on the business if she dies, but she worries about treating Nancy fairly. Therefore, Christiana's other assets are limited to about 400,000, and she feels it would be unfair to leave the business to Harry while only leaving 400,000 to Nancy. Wow, this is interesting. Then the next one is capital gain tax. Okay, so these are the issues that could arise, okay, upon the death of a key person or a business owner or entrepreneur, right? I hope you are following and I hope you are noting down all the key points we've been talking about, right? Let me take you back a little bit. If you don't have your notes, I always recommend that we have notes. You see, we are looking at a business life insurance, okay? And these are potential impacts of death on business. We look at loss of skills. We look at creditors' demand, the loss of skills when a key person in the business that skill is lost, and then getting somebody to fulfill that skills might take a while. And while we're looking for somebody to fulfill that skills, the business will continue to suffer, right? Then creditors' demand. As soon as people hear, bim, do you hear what? Do you know what? Have you heard? So and so person have passed away. And then the one that they'll say, what? Hey, my money, oh. And then they'll start running. Please, I want my money. I want my money. I want my money. And then in the case of this chaos, confusion everywhere, people, this is a family that have lost a family member. Now the creditors are coming left and right center, and maybe so the surviving partners or members of the family may not even know anything about the business or who is being owed. So it can just be messy, right? Then move on to family interference. Now everybody wants to be a part of the business, whether the one that is skillful or not skillful, experienced or not experienced. You see, as we can see in all this thing, those are the typical things. Like some of us, we may have even experienced similar things in our family already, where even not even siblings, extended families, uncle, all of a sudden, somebody that doesn't know that the family existed, when they hear that, oh, everybody is coming to see what they can grab. You see, family interference, unrest, creating commotions up and down. Then equality for fair family members. This one is a very sensitive, you understand, because you see, if you have many children, if you have more than one children, even oftentimes the kids will even accuse us, mommy, you don't like me. Like if it were to be another person now, you won't, this is how it happens. And then we don't even want that now to now be like when somebody passes away, to now make your own children to now feel like you have not treated them fairly. So these are issues that could come up when somebody owns businesses and death happens. And the last but not the least is capital gain tax. Okay? Have you guys caught up now? In case you lost your thoughts, or you are wondering what are we talking about? So I decided to just run back a little bit to bring you back on track. So again, if you don't have your notebook, it's good to have a notebook. All these things, just jot it down. You always reference it. There's a chart here. Okay, it's fine. Awesome. Thank you, sir. Thank you. Now, the last but not the least is capital gain tax. You see this one? When a Canadian taxpayer dies, they are deemed for tax purposes. You see, this one is every time I talk about this, or we're doing kitchen table, and I tell people, if in Canada, even dead people pay taxes. You know, people will feel like you are exaggerating, or we are trying to upsell them, or blah, blah, blah. No. When a Canadian taxpayer, and everybody pay taxes in Canada, right? They are deemed in bracket for tax purposes to have disposed of their property at its fair market value immediately prior to their death, unless a spousal rollover applies. Unless they are married and those assets roll over to their spouses. And the only person it can roll over to is their spouses. It doesn't roll over to children tax-free. So it's important to know that. So the capital gain tax that will be payable is calculated as follows. Taxable capital gain is equal to fair market value of business shares minus adjusted cost basis. ACB is here too, multiplied by 50%. We broke down ACB this morning. So you guys run to that recording this morning because I took my time to dissect adjusted cost basis. When you watch this morning class, ACB can never be a mystery to you anymore. Okay? So, yeah, you see the calculation? This is huge. The market value minus adjusted cost basis multiplied by 50%. So, if this family, if this person have what, let's say $1 million business now, right? And then the adjusted cost basis is 500,000. So it means there's a capital gains tax of $500,000. So $500,000 times 50%. 50% of that is capital gain tax that will have to be paid. So if there is $500,000, 50% of $500,000, that's 250,000. Where would this business get this money from? This is not a cliche. This is not a, in fact, this is not my words. This is what it is, right? So now the following, these are the tax owing, taxable capital gain. See, go through this table. Again, every time we have table like this, I recommend you go through it. Okay, this is fair market value is $1 million. Adjusted cost basis, oh, is even 100,000. Me, I was using 500. You see, capital gain is 900. Taxable capital gain is equal to 450. Imagine 450,000. Then tax owing, if MPR is 40%, is 180,000. Oh my goodness. Then we have a second example here. Okay, so let's go through that table, go through these examples. Okay, now let's look at business types. There are what we call 3 different types of businesses. Businesses may be structured in 3 different ways. Number 1, sole proprietors, partnership, or corporation. So we're going to look at each of them. Again, this business type, that one is a straightforward journey. Okay, so there's no complicated whatever in this one. And as we continue, if you have any questions, feel free to unmute yourself and then ask your questions or say whatever you have in your mind. Okay, so what are the attributes of a sole proprietor? A sole proprietorship is is the least formal structure of the 3 structures that are available. It has one owner who personally pays all expenses and personally earns all income. A sole proprietor is usually the operator of the business and the death of the sole proprietor could have a catastrophic impact on the business. The business itself is not a separate entity from the sole proprietor and has no adjusted cost basis, and assets of the business, such as product inventory, becomes part of the owner's personal estate at death. Very much straightforward. So this one is, there's what we call a commingle of whatever the person own and whatever the business owns. So the person in a sole proprietor situation, the business, the person, they are one. You know, the person is in business, the business is, everything is one. And as a result, when that individual passes away, right, whatever the business own becomes a part of the estate of that individuals, right? The assets of the business, such as product inventory, becomes part of the owner's personal estate at death. Okay. Now let's move on to partnership. Well, in the case of a partnership, partnership is a business that is owned by two or more people who have the common purpose of earning profit. Okay. Now, each owner has a partnership interest, and there are several forms of partnership. And these are partners who receive shares, okay, of partnership becomes, um, a partner who receives a share of partnership income is jointly and severally responsible for partnership debt and liabilities. All right. Note that a partnership must always have at least one general partner. A partnership cannot be composed entirely of limited partners. Okay. Everybody cannot be limited. There must be a general one that will carry all the whatever. Okay. So a partnership interest has some of the same attributes as corporate shares. It has a value, it has adjusted cost base, it can be a capital, it can have a capital gain or loss. It can be bought, sold, or bequeathed or given through a will on death of the partner. So from a tax perspective, each partner must report their shares of net partnership income on their personal tax return. Okay, and because a partnership interest may give rise to a capital gain upon the death of the partner, a tax liability may also arise at the partner's death. So therefore, the impact of this tax bill can be devastating unless it is anticipated through a careful planning. Wow, this is interesting, very interesting. So let's move on to corporations. So we've looked at sole proprietorship, we've looked at partnership. Now we're looking at the third ways businesses can be structured. So the third one, and these three different ways have their own tax, um, the way the taxes impact them as well, right? Now, a corporation is a legal entity in which shares of the corporations are created, and the individuals who receive or buy those shares are the shareholders of the corporation. Right? That one is very, very straightforward. Okay? Shareholders of the corporation is separate and distinct from the shareholders who are giving rise to a capital. Okay. Who are corporation is separate, who are not personally liable for the debts and liabilities of the corporations unless they personally guarantees those debts. Shareholders. If there are directors of the corporations may be held personally liable for the company's income taxes, and any amounts that are deducted as source from payroll, such as employment insurance and Canada pension plan premiums and employees' income taxes, tax withholding. Income received by corporations may be paid to shareholders as salary. And if the shareholder is employed by the corporation and as stock dividend to all shareholders. So like policy dividend, stock dividend are not guaranteed. The corporation's shareholders do not report the company's net income on their tax returns. Instead, that net income is taxed in the corporation. And then after-tax corporate profits are either retained in the corporation, increasing share value, or are paid out to the shareholders in the form of dividends. Okay? Now, shares have value and an adjusted cost basis that can lead to a capital gain or loss when they are sold. As with the partnership interest, the resulting tax liability can be significant and should be considered during estate plan. Okay, so the next one is public versus private corporations. So we have public and then we have private corporations. There are some significant difference in tax rules for public and certain private corporations. Shares of public corporations are traded on the stock exchange, such as TSX, which is Toronto Stock Exchange. Okay. Let's see here. So the private ones are ones that are owned by maybe families, individuals, and stuff like that. Those ones do not sell their shares. So I'm looking for where I stopped. So this is 219, this is 218, 219. Okay, shares of a private corporations are not publicly traded. I just say that. And they are issued to employees and others with an interest in the business. A Canadian-controlled private corporation is a private corporation that resides in Canada and is controlled by a public corporation. So a CCPC shares are also called qualified small business corporation shares because they may qualify for a capital gain exemption. There are specific rules that set out how a company may qualify for a capital gain exception, but these rules are beyond the scope of this discussion. Hallelujah. So we don't need to worry about that one. Okay. So we move on to capital gain exception. I thought they just say capital gain exception is not part of our. Anyways, oh dear. Let me have a drink of water.
Yeah, go ahead. Yeah.
We are moving on to capital gain exceptions. So how do businesses or corporations gain exceptions when they have made profit? Okay, for the purpose of this module, the most important tax attribute of CCPC is that upon actual or deemed disposition, the shares may be eligible for the lifetime capital gain exemption, which is LCGA. So the lifetime capital gain exemption for a CCPC is currently set as $883,384 for 2020 and is to be indexed annually for inflation. A taxpayer can use the LCGE, which is lifetime capital gain exception, to eliminate or offset capital gains realized upon the disposition of qualified shares in a CCPC. Therefore, a farm, or a family fishing business Sorry, therefore, let me see here. I want to see how does this connect? Realize upon the disposition of a family farm or a family fishing business. Now, the formula is calculated like this: capital gain minus LC, that is life, what is it again? A lifetime capital gain exception multiplied by 50%, which is taxable capital gain. Okay, and here we have that examples. Remember, this lifetime capital gain exception is only applicable to these businesses upon disposition. Okay, it's not that it's something you wake up and said, okay, I'm entitled, okay, because I have a small business, and no, as long as that business is in operation, you cannot claim that lifetime capital gain exception. It's upon disposition. If you sell that business, then you can take advantage of that. Okay? So take your time to read this example here. And like I admonishes this morning class, whenever you see example like this, and it has numbers, it has mathematics, except you are a genius. I know I'm not, right? But if you're a genius and you are one of those individuals that when they just see a number like this, boom, a stamp in their brain, then you're good to go. I recommend that you do what works for you. However, I really recommend to have a pen and paper. Even when you have example like this, write them down, because as you're writing, is registering, is, you understand, you get to drive in the understanding deeper and better than reading calculations. Okay, now let's move on to key person life insurance. So now we've identified problems. You see, we identified 5 problems, remember, at the beginning, right? Before we move on to the different kinds of corporations, then the different types of tax implications on those 3 different kinds of corporations, which is sole proprietorship, partnership, and corporations, right? Now we are now going back to those 5 problems that we identified that could result that come up as a result of the death of a key person in the business. How do we solve that problem? Right? So this is where we are now. We are in the solution phase now, right? And the solution to that key person, this thing is what? Key person life insurance. Okay? So here we see that earlier we reviewed the concept of a key person in a small business and the potential negative impact if a key person dies unexpectedly. In order to protect against those negative consequences, a company can insure its key person. In this case, the company receives the death benefit if the person dies. Okay? So, it's somehow for one to see that this is a looming problem, and then you still choose not to do anything about it. That's what a lot of people are doing. You see a lot of people, their own businesses, they are the key person to their business, and yet there's no plan in place. And that's why what you and I do is very important. See, we need to go out there to help these individuals. We need to go out there to show them, like, okay, what plans have you put in place? If anything were to happen to you today, what would be the fate of your business, right? So this is an example here. All right. A1 Industries has a salesperson, Elaine, who is a star. She alone is responsible for over 60% of revenue. A1 takes out a life policy on Elaine, naming itself as a beneficiary. If Elaine dies while a key person for A1 Industry, A1 could use the money to replace her, right? Use the money to replace her, or um, let me see, or show up. I can't see. Oh my God, I wish there's a way to move this. Or show up revenue during the search for her replacement. You see what a key person life insurance can do, right? So by taking a key person life insurance, you see, you can take life insurance on anybody so long as you can prove that you have insurable interest. Okay, again, don't get me wrong. When I say anybody, not that if you go and take on somebody that is not related to you, and no, this one now is called key person because this company will have to demonstrate that Elaine or this employee is fundamental to the success of their business. Make sense? All right. So that is key person life insurance. So what that does is that when that key person passes away, the insurance company, while they are looking for replacement, that death benefit they will receive, they'll be able to use that to sustain their business. Imagine this individual that is responsible for 60% transactions in their business. It means that overnight, their business will crash by 60% or more. How do you think they will survive? There are fixed costs that must be undertaken. On those fixed costs, whether they make sales or business comes or not, those fixed costs are there to be taken care of, right? So at least with the debt benefit, the company can, survive and keep up until they hire a replacement. So we move on to split dollar arrangements. So a split dollar arrangement is a method of sharing the cost and benefit of life insurance between two parties, such as a corporation and its key person. Okay, typically the agreement is between two parties and is used when more than one people or entity requires the benefit that can be provided by a life insurance policy. In common split dollar arrangement, a life insurance policy could be jointly owned by a key employee and the corporation for which they work. Oh, so the specific arrangement could be structured in several different ways. For example, the employee could own the death benefit while the company own and control the cash value of the policy or vice versa. Wow, this is interesting. So this is more like a quid pro quo, right? Because now, so this one is called a split dollar arrangement. Because when you take policy on a key person, right? Some people, may like, they may put up a show like, so you are taking life insurance on me, and how am I sure that if not that it is here, if it's somewhere in the world, that employee, you better be watching your back. You get what I'm saying, right? Uh-huh. But so this second one here is a split arrangement. This is like a win-win situation for both the employer and the employee. And they could do this arrangement in case of universal life. They could do this arrangement that, okay, you, the employee, you will take the death benefit, then company takes the cash value, or depending on the way they structure it, okay? Each party to a split dollar arrangement pays a portion of the premium in a way that recognizes their separate economic interest in the policy. In the final example, in which the corporation owns the death benefit up to the original face amount, the company's shares of premium will be tied to the reasonable cost of the comparable term insurance coverage, while the employee pays the balance of the premium cost. Wow. So this one, the employee pays part of the premium, the employer pays part of the premium. But at the end of the day, they structure the benefit such that at some point it will meet halfway. So let's say if the face amount is 500,000, then if the employee keeps the face amount, that is the death benefit of 500,000, then the employer keeps the cash value until the tune of that same 500,000, where it will now become at par with the face amount. Okay, but that's interesting. So we move on to the third one, which is taxation of key person split dollar arrangement. You see, everything, salary must be there now. If they have not mentioned them, it means that, you see, so what is a tax? How is the tax structure? You see, this morning we saw when we had group plans, right, that the premium paid by the company is tax deductible to the business. However, the employee that receives the benefit have to the benefit is a tax dollar amount to the employee. So now let's go here and see. You see why I shouldn't miss classes, because all these things, they're somehow tied together, because those terminologies, they escape common anyways. So how is the taxes calculated in this situation? Well, there are no formal income tax rules governing split dollar arrangements. So the administrative practice of Canada Revenue Agency has been to recognize the premium allocation between the employee and the corporation as a reflection of their fair market value of their respective interest in the insurance contract. That's fair enough. Upon retirement or termination of employment, the ownership interest in the death benefit could be transferred to the departing employee. Yeah, which kind of makes sense, right? Because if you take this insurance on this person's head, right? Claiming that, okay, you are taking this policy because if this person were to pass away, your business will suffer this, your business. So if the person is retiring or is leaving your business, at least it will be fair enough to just, he's not going to be there anyway. So his death or whatever will not impact your business. So you might as well transfer the ownership and all the rights. But that means the person may have to maybe pay something to the corporation. Let's see, upon retirement or termination of employment, the ownership interest in the death benefit could be transferred to the departing employee, depending on the fair market value, right, of the policy. The transfer might result in a taxable benefit for the employee. Yeah. So by the time they transfer it to the employee, so the employee might, you know, attract some taxable benefit there. All right. A key person insurance may have to be assigned to the financial institution providing the loan. Okay. Oh, sorry. I jumped somewhere. The employer adjusted coverage. Wait, let me go back. You see, this jumping thing has affected me. Depending on the fair market value of the policy, the transfer might result in it. Okay. Now, if the policy is surrendered, then the employee will have to report a policy gain for the difference between the cash surrender value and the ACB. Okay, just like we treated this morning. Okay, so move on to the next one. As a requirement for borrowing, So this key person insurance, okay, remember we identify some of the impacts, right, of um, the death of a key person or an entrepreneur, being that the lenders will become very agitated, they will get agitated when they hear that the person have passed away, right? Now, for some people, they might even want to see this key person insurance before they borrow money to a small business, because they want to be sure that if anything happens, they'll get paid. You see, that's so typical what happen when you want to buy a house, right? The bank will be asking you for mortgage insurance, right? If you have life insurance, before they don't verify, but now, even when you say you have life insurance, they verify it first, right? And if you don't have life insurance, then the bank will give you the mortgage insurance. All that is to ensure that if anything were to happen to this individual, at least the life insurance will rise up to the occasion to ensure that they get paid, right? How many of us here have experienced that, like you buying a house and then you have to provide either proof of life insurance or take mortgage insurance?
Yeah,
Did you with
I've
similar
experienced
that?
that.
Sorry?
Yeah, I have. I have experienced that.
You have experienced that, right?
Yes.
Aha. See that? Okay. So that is similar to what we are discussing here. Some lenders will want that as a requirement for borrowing. If the success of a business depends on the involvement of a key person, a lender may be reluctant to loan money to a business without the assurance of a key person insurance. A key person insurance may have to be assigned to that financial institution providing the loan. You can see the similarity there in what we are learning here to that of mortgage insurance, because you see, when you take mortgage insurance through the bank, the beneficiary of that mortgage insurance is who? Who is the beneficiary?
The bank.
So the
The
bank.
bank. Yes, the bank. So you can see that the way this thing works, right? The financial institution will want that coverage to be assigned to them so that there'll be no story, because the person they're giving money is gone. So who would they go and meet to sign? So assign to them so that they head or tail they win, right? So
Yeah.
the person insurance may have to be assigned to the financial institution that is providing the loan. So they have it. Bam, anything happens, they are the one that will go and claim the money. You see, the death of the key person will result in a death benefit paid to the lender in the sum of the loan. Okay. And if a business acquires a key person insurance because a lender requires it, then the business can um, deduct it from its income. So the cost of the premium, if a term policy is issued, is used, and then the cost of the pure insurance if the permanent policy. So the premium paid for this policy is tax deductible to the business. Okay. So we move on to buy sell agreement. Again, this section, please pay attention to it because this is an exam question. Okay. So we're moving on to buy sell agreement. I hope we are following so far. This is straightforward, it's not complicated. But if you have questions as we go, feel free to ask. You see, a buy sell agreement specifies what happens if a business with multiple owners and one happens to die. Okay, so this buy sell agreement is like a stipulated plan that is set in place. You understand, that will kick into effect in event that one of the key person or owners of the business passes away. The important detail for consideration here are who can or who must buy the deceased owner's interest. And then the cost of that interest and how the cost will be determined. Then how to pay for the deceased owner's interest. Okay, so these are the important factors or important details to put into consideration. Buy-sell agreements can also specify how a buyout is structured if an owner wants to leave the business, retires, or becomes disabled. Okay, we have cross-purchase agreement. With a cross-purchase agreement, with a cross-purchase buy-sell owners, buy-sell agreement, yeah, the the owner agreed to buy the interest of a deceased owner for a corporation. This means that the total number of shares outstanding and the value of those shares remain the same, but each surviving shareholder now owns a greater number of shares. Okay, let's take a look at this example. See, so when you are looking cross-purchase agreement, so you're looking at something like this. You see, this is one partner, this is one partner. They are not increasing the number of shares. Maybe let's assume there are 3 partners, right? And they have 1 million shares or 500,000 or 1.5, they are not increasing their number of shares. But what is going to happen now is that the number of shares that the surviving owners are going to have will now increase. But how would they have money to fund and buy the shares of these deceased partners? That's what we're looking at here. You see, for corporations, this means that the total number of shares outstanding and the value of those shares remains the same. You see, they are not increasing the number of outstanding shares, nor the value. Everything remains what? Remains the same. But each surviving shareholder now owns a greater number of shares. For example, Bob, Calvin, and Dylan are the 3 shareholders of a small incorporated business specializing in recycling paper. They each own 100 shares, which are currently worth 10,000 per shares. They recently entered into a buy-sell agreement, which says that if one of them dies, the survivors will buy his shares for their current share value as determined by the company's financial statement. Okay, if Bob dies today, this means that Calvin and Dylan will each buy 50 shares from his estate at a price of 10,000 per share. Bob's estate will receive what? $1 million. And Calvin and Dylan will now each own what? 150 shares each. Now, the total number of shares outstanding is still 300, but Calvin and Dylan now have what? 50% interest, have a 50% interest instead of 33.33 ownership that they had before the death of Bob. Okay, that's pretty much straightforward. So with a share redemption plan, the corporation buys the shares of the deceased owner, and this reduces the number of shares outstanding, but the survivor's owner's interest increases. For example, so this is a different form of arrangement, right? Where is this example again? Okay, so this is an example where it's Emily. Emily, Fatima, and Gloria are the 3 shareholders of small incorporated business specializing in health products called Forest Air. They each own 100 shares, which are currently worth 10,000 per share. They recently entered into a buy-sell agreement in the form of a share redemption plan with the company, which says that if any one of them dies, the company will redeem her shares for their current value as determined by the company's financial statement and will cancel shares retained by the company, of which the total will be 200. If Emily dies today, this means that the companies will pay 1 million to her instead. Fatima and Gloria will still own 100 shares each. But because the number of outstanding shares would drop to just 200, they will now each have a 50% interest in the company instead of 33.33% ownership interest that they had before Emily died, before Emily's death. So this is another way. This one now, the shares has to reduce, but the other one, in terms of purchase agreement, the share value does not go down. Okay, so that is on that one. Then why buy-sell agreements are important. A buy-sell agreement is essential among business owners to protect the business, to protect other owners and their beneficiaries if one or more of the owners dies unexpectedly. A properly funded buy-sell agreement protects the surviving owners and the business and the beneficiaries of the deceased owners as well. So the critical elements of a buy-sell agreement are discussed below. Number one, it guarantees a buyer, okay? Because what happens if there's no money, for the remaining shareholders to buy of the outstanding shares? What will happen? There will be nothing to do, right? So, but this buy-sell agreement guarantees a sale of the shares, usually to surviving owners or the business itself. Okay, and inversely, this guarantees money going to the estate of the deceased individual, which will provide the much needed money that the family will need, as the case may be, right? Then we also have mandatory skills. Also, no, the next one is guaranteed value. Okay, so the price at which the sale is transacted is also guaranteed by the agreement. All right. This is fair to the inheriting owner of the shares and prevents a fire sale in which the shares price can, drop sharply or discounted simply to attract buyers. And also because of this now, because it's um, a buy-sell agreement, so it means that the price have already been negotiated by the deceased individual even before the person passes away. So this will contribute to the family of the deceased getting that comfort, that peace of mind that yes, what we are getting is the best that is due to us because their deceased family member would have been, involved in the negotiation before they passed away, right? So we move on to mandatory sales. We see one of the things that key person life insurance help to solve, is mandatory sales, right? A buyer-sell agreement protects, you see, a buyer-sell agreement protects surviving owners from the unknown survivors, okay? No, what am I reading? Sorry, let me start again. A buy-sell agreement protects surviving owners from the unknown. Okay, survivors know they will receive the shares of the deceased with a buy-sell agreement. The estate must either sell the shares to the company itself, that is in bracket, a share redemption plan, or to take the surviving owners in a cross purchase agreement. Okay, so yes, this is a mandatory sales. This guarantee funding through life insurance. Again, the benefit of this buy-sell agreement is that the surviving shareholders are not going to start scrambling around. Oh, where are we going to get money? What are we going to do? No. A life insurance provides an absolutely secure method of funding the purchase of shares from the estate of the deceased owner will need or require. How life insurance is used is described in the following sections. Okay? So again, this is the benefit of buy-sell agreement. Now we move on to crisscross insurance. So what is crisscross? We looked at buy-sell agreement. Now we are looking at crisscross insurance. And a crisscross insurance is an arrangement known as a crisscross insurance. It's often used to fund cross purchase, buy sell agreement with a crisscross arrangement. Each party to the buy sell agreement buys life insurance on the other party through the agreement in an amount sufficient to cover their purchases, their purchase obligation upon the party's death, for example. So this is, you see, like the one we saw earlier is, buy-sell agreement. But this one now is crisscross, okay? So if I'm in business with Mr. A, so I will take policy on Mr. A, and Mr. A will take policy on my head. Okay. But this one, it has to be somebody that somebody trusted very well, Sha, because kind of crisscross. Oh my goodness. Let's look at an example. Recall the earlier example where Bob, Calvin, and Dylan each own 100 shares, which are currently worth 10,000 per share. Currently executed a buy-sell agreement which says that if any one of them dies, the survivor will buy his shares for their current share value. Okay? At $10,000 per share. Bob is the youngest of the three owners. He is only 32 years old and is excellent health. Dylan, however, is 54 years old, overweight, and a smoker. With a history of hypertension, Bob will pay much more 500K of the coverage of Dylan's life than Dylan will pay for 500 coverage on Bob's life. So Bob doesn't think this is fair, considering the fact that both of them, I think I jumped something. Okay, so let me take a step back here. So Bob will buy 500. Okay, so no. A crisscross arrangement known as a crisscross insurance is often used to fund cross-purchase buy-sell agreement. With a crisscross arrangement, each party to the buyers to buy-sell agreement buys life insurance on the other party to the agreement in an amount sufficient to cover their purchase obligation upon that party's death, for example. Recall the earlier example where Bob, Calvin, and Dylan each own 100 shares, which are currently worth 10,000 per share. They recently executed a buy-sell agreement which says that if any one of them dies, the survivors will buy his shares for their current share value. Okay? Of 10,000 per share. Bob is the youngest of the three, of the three owners, he is only 32 years old and in excellent health. Dylan, however, is 54 years old, overweight, and a smoker with a history of hypertension. Bob will pay much more for 500,000 of coverage on Dylan's life than Dylan will pay on coverage for Bob's life. Bob doesn't think this is fair, considering that the death benefit is the same for both of them. Dylan, however, maintains that it is fair because Bob is far more likely to collect on the insurance than he is. So because the insurance is not being used to secure a loan for business or investment purposes, the premiums are not deductible. Oh, to either the associates or the business. However, the death benefit will be tax-free. One of the disadvantages of the crisscross insurance is that there may be significant difference in the premium for the coverage required on each party, depending on their age and health. Jack and Alfred each owns 50% of the 200 shares of Jack All Inc., a frozen dessert company. Hmm. They implemented a buy-sell agreement funded with crisscross insurance. Jack died shortly thereafter. The overall process would look like this. From a tax perspective, the deceased owner is deemed to have disposed of his business interest for its fair market value just prior to death. So this will trigger a capital gain on the deceased's final tax return unless he can shelter some or all of the capital gains with a lifetime capital gain exemption available for the qualifying small business shares. And the long-term capital gain exemption for 2020 is this amount. Therefore, the surviving associates use the tax-free death benefit they received when the owner died in order to acquire the unit shares from his estate. Wow, interesting. So we can see that example here. So here we see Jackal Inc. So this is Jack own 50% ownership. This is Alfred 50% ownership. All right. So Alfred takes policy on Jack and Jack takes policy on Alfred. Wow. So, and this is the explanation of what, okay, just happened there. So move on to role of the capital dividend account, the CDA account, okay? So CDA account is capital dividend account. So now, let's see here. I wish there's a way I can scroll this without it jumping on me in such a way that I'll be looking for the last place I stopped. Okay, so let's look at the role of the CDA account. The business-owned insurance can be used. Again, sorry, before I forget, don't forget to come here and read this detailed explanation of this graph, okay? So this is an example and this is associated explanation. Take your time to read that. So let's take a quick look at CDA account, okay, as we wrap up chapter number 8. Now, business-owned insurance can be used to fund both cross-purchase buy-sell agreement, and share redemption plan. In order to understand how business-owned insurance can be an effective business strategy, it is first necessary to understand how the capital dividend account works. Okay, the capital dividend account is a national account which only keeps track of inputs and outputs for tax purposes. A private corporation uses its CDA to record amount it receives on a tax-free basis, such as a tax-free 50% of the capital gain and some or all of the death benefit received from a life insurance policy. So when the account has a positive balance, the corporation can pay a tax-free capital dividend to its to its to its shareholders. Okay, gotcha. So therefore, the capital dividend account is it's a national account which only keeps track. No, I've read this. Okay, so what's happening here? So when the corporation pays out a, oh dear, 230. You see, this is not moving. Hold on. I'm scrolling this. Okay, the role of CDA account and then dividend, free capital dividend to its shareholders. So when the corporation pays out a capital dividend, the CDA balance is reduced by the same amount. So know that only the portion of the death benefits that exceeds the policy's ACB is credited to the CDA account and ultimately paid out as a tax-free capital dividend. Therefore, the remainder, that is an amount equal to the policy's ACB, is taxable to the corporation. In the case of term policy, the ACB is zero, which means that the full death benefit can be credited to CDA account. However, for whole life or UF policies, a portion of the death benefit is equal to policy's ACB and is in fact taxable to the corporation. Wow. Recall from section. You see that? Recall from section G2 and G3 policies that the ACB of G3 policies tends to grow faster than for G2 policies in the early years. And it takes longer for that of ACB to reduce to zero. So therefore, this ACB pattern is beneficial for individual policyholders who surrenders their policies prior to death benefits or prior to death of the life of the insured, because it reduces their policy gain. However, it is less favorable for corporate-owned policies because a greater portion of the death benefit ends up being taxable. So you see, when I was seeing G2 and G3, right? So don't worry, guys. Go into today's class. All those G2, G3, it means group 2, group 3 policies, and G1 are the grandfather policies. We broke those down in the morning. Okay. Funding cross-purchase buy-sell agreement. Well, in a cross-purchase agreement, is funded by corporate-owned insurance. Usually, the corporation is named as the beneficiary of the policy. So when one shareholder dies, the surviving owners purchase the shares from his estate, often using a promissory note, and the insurance company will pay the death benefit to the corporation, which will credit the amount to its capital dividend account. Therefore, the surviving shareholders would then direct the corporation to pay them a capital dividend, which they will use to pay off the promissory note. For example, in the case of Jack and Alfred, cross-purchase agreement, instead of funded by insurance owned by Jack Incorporated. If Jack dies shortly after all, then thereafter, then the overall process will look like this. So we can go back, take a look at this table, and then take a look at the one we've seen before and this associated explanation. Okay? Funding shared redemption buy-sell agreement. How do we fund shares redemption buy-sell agreement? Well, in the case of shares redemption plan, the company and the shareholders are all parties to the buy-sell agreement. Therefore, the company buys life insurance on all of its shareholders, naming itself as the beneficiary, such that when one of the owners dies, the company uses the death benefit to redeem the shares from the deceased shareholder's estate. For example, also suppose that Jack and Alfred, instead of entering into a buy-sell agreement with Jack Inc., structured as a share redemption plan funded by life insurance or life insurance owned by Jack Inc. When Jack died shortly thereafter, the overall process will look like this. And here is the explanation. And that brings us to the end of chapter 8. All right, so let's talk and chat. Should we go to chapter 9? Or we should stop here for tonight. It's 9 o'clock because of Monday morning.
I suggest we can take a break here.
Yeah.
Okay.
That's fair enough then. All right. Any question
Okay.
before we go for tonight?
No questions.
So this one is very
That's-
straightforward.
Yeah, this one is very
Yeah, we're trying to
Yes,
shut
this
up.
one is. Yeah.
This one is okay. That's good.
yes.
Okay, so I'll try and complete chapter 9, and I will put it in the group. I'll recommend that, you see, we are not having class again until Saturday morning, 5 a.m. Mountain Time. So don't pack up your books, please. So use have your own personal schedule for yourself. Rewatch the videos. I try my best. I'm not a teacher. I'm not, so I'm just trying my best, and I hope that this support I'm able to provide for you guys, I hope it's helpful, and I hope it helps you guys to get this exam out of the way. Watch the video and then practice the chapter by chapter question. Okay, practice the chapter by chapter question, and I would like to see your scores. When you practice it, take a screenshot. Let us support each other. Let's bring the vibes, the energy, so that we don't come back Saturday morning and it's like nobody have done anything. So we won't be able to achieve our goals like that. Okay? So on that note, I want to say thank you very much. It's been a great start weekend for us, and
Thank
you guys
you.
have a great week.
Thank you so much, ma.
Have a great
Thank
night.
you.
Time and
Cheers,
everything.
everyone.
Thanks,
thank
everyone,
you.
Bye.
too. And
Bye.
have a
So
great
please,
week.
let's keep posting in the group, okay?
Okay. Thank you. Bye bye.
Bye.
Bye.